Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, we're going to be talking about how a trader might decide when to use tighter stops versus looser stops when they're buying long options. It might seem to be inconsistent. The trader might change from one to the next. However, sometimes applying an absolutely consistent approach to a strategy from one stock to the next, from one trade to the next, may deliver inconsistent results. So we're going to be talking about tailoring stops to a specific option strategy. Should be a really interesting discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there on YouTube. Great to see so many familiar names. I've been chatting back and forth with some of you already. Hello there, Sharon and Janelle, Richard, Jack, Will, David, Josh, Marcus, Greg, Eva, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Tuesday webcast series. We kick it off promptly noon Eastern time. And I also want to let my live stream audience members know that we have Connie Hill hanging out in chat with us. Connie and I have been working together for a long time, many years. So Connie's a great resource to have there to help out. Connie, thanks for having my back. And Connie and I would like to issue an invitation to everybody listening. If you have an account with X, you should be following your favorite presenters on that platform. It's the best place to connect with your favorite presenters in between these live streams. So you can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. But let's get into this discussion of tailoring stop orders to the specific option strategy. As we do, of course, we need to bear in mind that risk is real. These disclosures are important, so keep them top of mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so here's what we're going to be talking about today. Today is all about risk management. And I think in the spirit of being consistent from one trade to the next, some traders just conclude, well, maybe I'll use a fixed percentage as a stop to manage the risk on my long options, whether I'm buying a call on Apple or a call on Netflix. Maybe we're just going to use a, who knows, 25, 30% stop, whatever it is the trader might use. However, fact remains that not all options are built the same. And so maybe the trader might want to have a gauge for the amount of volatility in an option, and that might assist in the tailoring of the stop placement on those trades. And that's what we're going to be exploring today. We're going to be weighing placing stops in the money and out of the money on options and how that might affect where that stop is placed. Let's go right to the Thinkorswim platform, though. We're going to be illustrating this with an example trade today and even placing an order for that trade with a tailored stop. So Jose says, are the pros and cons to stops? That's definitely something we need to talk about today, Jose. But going to the S&P 500 first, let's just get a little bit of a backdrop for the sort of markets that a trader might be dealing with as we're having this discussion. So we're peeling back a little bit today off of those all-time highs. This is a Tuesday webcast. On Friday, just last week, the S&P made it up to record highs again, and we've sagged back a bit, maybe about 1% off those all-time highs, now down about 0.4% on today's trading session. But overall, let's say that our trader is maybe making a plan for a trade, possibly going out here to that September 3rd Friday expiration. And they just wanted to gauge, do the markets still seem to be bullish? Are there real signs of bearishness yet? Are we going to be doing a long call example today or a long put example trade today? Let's just say that our trader is bullish, right? And so they're going to go ahead with a long call trade. So that's what we are going to be doing today. Let's say that our outlook is for things to generally, if we continue pulling back for a day or two, as long as we start to advance again before too long, then that should start to provide a bit of a tailwind, bit of a lift for long calls, if things go that way. Time will tell, but that's sort of the premise for today's discussion. It's the logic of why I'm using a call example. Now, there's another bit of logic to using a call example when introducing a new concept. That is, for some reason, I think for a lot of traders, there just is it's more intuitive to learn something with a call, a bullish strategy versus a bearish strategy, which just maybe it requires just one little logical step in that learning path. So let's just keep it as straightforward as possible. We're going to be using a long call today. So let's go find an example stock. Now, among a multitude of potential other considerations when selecting a stock on which to trade options, as we've discussed in the past, it can be all sorts of reasons. It might be because of somebody's convictions regarding a sector, or regarding maybe a company is just really fundamentally strong in their view. But some fairly common threads in selecting a stock are price per share, the liquidity of the options, and the stock chart itself. Now, not everybody uses those three, but price per share can obviously have important implications regarding the cost of the option, if the contract were to be exercised or assigned, the size of the right or the obligation, that sort of a thing. So price can play a role. Liquidity is, I can't ever say universal, but broadly tracked by traders of options, because if we have an illiquid option, it tends to have pricing issues, a big drift between the bid and the ask price. It can make it harder to get into, harder to get out of, harder to trade profitably. So liquidity is a consideration, and also maybe what a trader sees on the chart. So I want to use as today's example for our bullish trade. Here's Costco. Now, Costco is actually down just a hair today along with the rest of the markets. Maybe the trader's okay with that, but what a technician might note is that after a pretty sizable pullback, Costco has shifted into recovery mode. So Harry says, will you discuss a profit exit with a trailing stop? Trailing stops are not going to be today's discussion. Harry, my apologies. It'd be introducing a new element to what I have planned, and we'd have to weigh the pros and the cons of that approach. We will be using a target exit, not a trailing stop exit. All right, but recently, after this pullback, maybe what a technician might note is that the stock has started to advance, ran up to a peak. Let's maybe zoom in. After we hit these lows, where did we hit the ultimate low? Back there, July 30th. Our stock started to advance, ran up for about 3.5 days and then pulled back, ran up for about another 5 days and it has pulled back. And then just as of yesterday, looked like we were shifting into recovery mode again, and we're still within 0.1%, or right about that, of yesterday's close. So maybe our trader has an outlook that this new emerging bullish momentum might carry that stock up, possibly to the extent that we've already seen. We've had a relatively large move here, a comparatively smaller move there, but overall, what were the size of these moves? We had a peak right here at about 960, coming off a low back here of about 925. So there's about a $35 move to the upside. This one was much larger, went from a low down here from 935 up to about 990. So that was about a $55 move. So if we had 35 and 55, maybe our trader is looking for somewhere in that range. Maybe as little as 35 expectation, possibly as much as 55. Here's what the trader might do to gauge in their planning of this bullish trade. Might look at this low. How about we split the difference there? 35, 55. What would a $45 move off this low look like? Well, looks like our bottom there was at 967. Let me do some math here. We had a low of 967. Let's add $45 to that, and that would give us a target right around, let's just call it 110. Okay? 110, if we zoom back out here, that might carry us from this low up to, who knows, about there-ish, which is going to be pretty close to this previous high, pretty close to those previous lows, right up into that range. Some interesting things happening here for technicians. They might see, is this a bit of a bull flag? And this would be sort of consistent logic with a bull flag. Could we also, if we're able to break up above this resistance here, could it be an inverted head and shoulders? That's a possibility. But in any case, I'm just going to go with just a simple measured move. Simple is a strong word. How about just a direct measured move? 35, 55, splitting the difference. Let's look for 45. All right, so going back to the question about having a target in mind, we're going to be buying a call here, hopefully seeing the stock subsequently rising up to 110, and we're going to put in an exit up there at 110. Okay, so let's just draw in that line right at about 110 from today's entry. Carry that on out. Let's say that our trader is looking to hopefully get up there. How long might that take? That's another potentially important consideration for a long option trader. Looks like the first move was just a few days. The second move was about a week and a half. So this one, if we're being a little bit more generous, let's say maybe a couple of weeks. That can have an influence on which strike prices, or pardon me, which expiration is selected. Because if we think a move might take 2 weeks to play out, and the trader buys a 2-week contract, that's cutting it awfully close. A common rule of thumb is that a trader might gauge how long they might be in a trade and then double that for the amount of time that's actually purchased on the option. So for this one, let's give it a couple more weeks, and that is pretty consistent with going out here to that September 19th expiration. It's exactly 1 month from today. So that's sort of the concept of our trade, buying a long call, and we're looking to get out if we can get up to 110, or not 110, 1010. However, sometimes a stock just doesn't do what we think it's going to do. It doesn't go as high as we think it's going to go. Maybe it goes right on down, or it doesn't go up as quickly. Maybe it starts to make its way up, but it's advancing so slowly that for the options trader, it then becomes a battle against time. That can be a problem. That can chip away at the initial investment in that option, and it can actually turn a correct call on the direction into a loser. So trader might want to have a plan to manage the risk if the trade just starts to falter for some reason. And that's what I wanted to talk about today, is planning for the other side of the trade. What about these trades that go against us? Well, sometimes a trader, as I mentioned at the outset of this discussion, in the spirit of just trying to be consistent, maybe they come up with a rule for themselves. Well, anytime I buy a call, for example, maybe I'm going to use a 25% stop or a 30% stop. There is an inherent problem with that sort of approach, and that is that not every call carries the same degree of leverage, and the trader needs to be able to gauge that. So how do we gauge that? Here, let's go start to build a couple of example call trades, and then we're going to compare the amount of leverage, and it's going to inform us regarding how much, whether we're going to be using a looser or a tighter stop. So let's go to our trade tab. Let's go out here to the 19th of September, and let's look at things, first of all, through the eyes of maybe a trader who prefers to go in the money on the long options that they're buying. So how about we look at maybe this 970 call? If I were to buy that 970 call, there may be some math that let me maybe outline some math here. I think it's going to make it a little bit clearer. So here's example trade A, which is an in the money long call. Let's make that bold. You know that I prefer to have these bold, so it just makes them a little bit easier to see. So for this one, let's say we buy the 970, the 19th of September, 970 call, with the objective, hopefully the stock goes up to 1,010 and we take our profits. But that looks like that might cost us right now between $29.25 and $30.25. Let's split the difference. Let's say it costs us $29.75. Now there's another thing that I want to note here, and this is going to be key to this discussion, and that is the delta for this trade. The delta on that 970 call is 60. Now, this delta to the eyes of a veteran options trader gives us an important insight into, as a matter of fact, let's put the dot in there. There we go. Anyway, it can give us an important insight into how leveraged this trade is. Here's a couple of things we need to know about delta. Number one is it can tell us conceptually, the likelihood that a contract expires in the money. When we see a delta of 60, it's correct to state, all right, there's approximately a 60% probability that this contract would expire in the money. That's actually not the way we're using delta today. A second way that we might use delta is it can tell us very precisely if the stock were to go up or down $1. This is how much that option would change in value, assuming the other variables that influence options prices just hold constant. Yes, time plays a role. Yes, volatility plays a role, but let's just assume that we buy the call and the stock immediately just pops up $1. What kind of an unrealized gain would we, if we were to have purchased this at $29.75? Somebody do the math for me. And the stock immediately pops $1. How much would that trader have in an unrealized gain on that option? That'd be 60 cents. Or in other words, the option will have changed in value from $29.75 to $30.35. I had to do that in my head. Call me out if I get the numbers wrong, but I think that's right. Yeah, that delta tells us how much of a change we get. Now, what we can do with that information is calculate the percentage change expectation. So how much is a 60-cent move on basically a $30 contract? If I were to round this off to $30, let's just do that just to keep it sort of simple. If I pay basically $30 for this contract, and if it were to go up 60 cents in value, well, 10% of $30 is $3. 1% of $30 is 30 cents. So I know that a 60-cent increase in value would be a 2% change in the value of that option. Great if the stock goes up $1, but what if it goes down $1? A 60-cent change would be about a 2% loss in value on this contract. So just on a $1 move on the stock, we're looking at an investment that can change 2% in value just on that $1 move. You might think, well, okay, $1, that sounds pretty good. $1 on a $1,000 stock is a tiny little move. So you can see what degree of leverage. If we were just the shareholders and we got a $1 move up or down, it would hardly even register on our radar because it would literally be about 1/10 of 1% of a move on the stock. But this has leveraged that to a 2% move. It's close to 20 times the leverage of stock ownership. That's how leveraged this is. But let's just keep that in mind. And let's say that our trader had, I'm just going to throw out a random rule, okay? Let's say that our trader's plan is to have their stop at 30% below their entry price. We sign there. But we now know that a 60-cent move can produce a 2% loss, right? Approximately, not a 60-cent move, a $1 move can produce a 60-cent loss if we're going down, or 2% that we've lost on our option. So how many dollars of tolerance does this trade basically have if our timing's a little bit off? Wouldn't it be about $15? If we're losing 2%, stock going down $1. Yes, I know delta changes, but we're just doing rough math here. Yeah, this would have a tolerance for, let me write this right here. Tolerance for trade A is approximately $15, right? That's how that translates. Now I want to compare that. Let's do another example trade. Let's take this. I'm going to copy that. Let's look at example trade B, which is going to be an out of the money option. Let's say that instead of buying the around that 60 delta, what if we were to go out here and we were to buy it close to a 30 delta? Looks like there's a 29 right there. That's the 1015 strike. So we're going to buy, as a second example, the 19th of September, 1015. Now, obviously, if we're going out of the money, that really reduces the cost of the trade. So we're going from about $3,000 to closer to $1,000. Looks like we might be able, let's say that we're able to buy that for $9.50 per share, $950, close to $1,000. I think it'll be handy to just keep those nice round numbers in mind. Now let's run through the same scenario. Stock goes up $1 or down $1. Well, in that case, we'd be looking at a delta. It just changed on us. Now it's 28. Put that in 28. That's okay. It might flash back to 29 because markets are open. These things are changing live. But if you look at this in absolute terms, you might look at trade A. Hey, if the stock goes down, I lose 60 cents. Trade B, if the stock goes down, I lose 28 cents. Wow, trade B is way better. It's way more tolerant for movement. Actually, no. It's actually a much more volatile investment. Here's how we might look at that. A 28 cent change on a 950 investment, what percentage is that if the stock were to drop? 28 cents divided by 950 is going to be about 3%. Now, that doesn't sound like a lot, but a 3% change is 50% more damage done by the same $1 move in the stock. Now, what that's telling me, the story here is that trade B is 50% approximately, I'm going to throw that word in there, approximately 50% more volatile. Or another way to look at it is it's 50% more leverage. Widen this out a little bit so it fits. So here's an important message then. If our trader is using the same percentage stop on both of these, in the money and out of the money, which one is going to be more vulnerable to actually being stopped out? What do we think? It's actually going to be trade B. Trade B is going to be more volatile to being, it's going to be more exposed to being stopped out. It's inherently more volatile. It's going to be a bumpier ride. The same $1 move, $2 move, $3 move might stop us out. So in this case, if we were to use, let's say, a 30% stop, what would be the tolerance? Trade B. How far could the stock move in price before trade B got stopped out? Approximately $10. Does that make sense? If we buy this call and the stock falls 1% and we're down $3 in unrealized loss, and it does that, instead of falling $1, it falls $10, very likely we're stopped out. Well, it might still sound like, well, isn't $10 a pretty good amount of wiggle room on a stock? I don't know. Since this is nearly $1,000 stock, we're literally saying we have 1% wiggle room on this trade. 1%. How precise is your timing? That's the question the trader might want to ask themselves. Another thing they might do is just go to the chart. And if I were to go look at some of these recent moves, let me look at some of these candles. What was the size of this candle, top to bottom? That was an $11 candle. We only have a $10 tolerance here. This one, that's an $11 candle. This one, that's a $13 candle. If you look up here at the R for range, that's the range from the high up to the low of the day. So this stop, if we have a 30% stop on this option, we're literally saying we can't even have a single day's normal size candle go in the wrong direction. This trade's over, right? Now, some of you are proposing some other ways that we might use the stock movement to gauge, the volatility. Now, that's actually a measure of the volatility of the stock using something like the average true range, the ATR. I wanted to have a discussion about the volatility of the option that's a derivative of the stock. So you're raising some good points, but here's sort of the bottom line for our trader who is aware of the degree of leverage and how it might influence the trade decisions they make. What they might decide is when they're going in the money, maybe we can get away with tighter stops. As we go further out of the money, we might need to loosen those stops. So for some traders, they might have a set of rules, like as an example, this is just me giving an example. But let's say that if our stock has a delta of 60 or greater, those are going to be sort of the less leveraged options. And maybe the trader uses something like a 30% stop. If the trader chooses closer to at the money, and those at the money options are going to be the ones that have deltas between, like, let's say 60 and 30. In this case, we have quite a few because it's such a high price stock. There are going to be a bunch of stocks here, or a bunch of strikes. But generally speaking, those that are in between the 30 and the 60 delta are going to have more leverage than the in the money options, but not as heavily leveraged as those that are way out of the money. And so on those, maybe our trader does something like a 50% stop. And then finally, when the options are far out of the money, lower than, you might have already noticed this, if we have a less than 30 delta, those options get quite volatile. And it may just be the trader's decision. You know what? If I'm going to spend $1,000 on this trade, I'm going to risk $1,000 on this trade. It might be worth it to them in pursuit of those of the potential for reward, especially in those bigger moves on stocks. They may not use a stop at all. That almost sounds to some traders' ears, that sounds irresponsible. Why would I not have a stop? Well, actually, sometimes when using a stop on a highly volatile highly volatile asset, like an out of the money contract, it can increase the risk of an unprofitable outcome. Sounds weird, but yep, as we're whipping around, it might be true that somewhere along our way up to our target, it just makes just the wrong amount of a move downward, stopped out, and then the stock goes where we were thinking. But there we go. So I thought that was an important discussion to have when selecting options. In the money, typically, a trader might use a tighter stop. Out of the money, looser stops. And I just provided a range as sort of a guide for the concept. So Josh says, apologies, how did you derive the tolerance for A and B at 15 and 10 respectively? 30% of what value? So Josh, so this is assuming a stop of 30%, meaning a stop of 30% of the invested amount. All right. But if we've decided, okay, if that option were to change by 30%, and this one changes in 2% jumps, this one changes in 3% jumps, meaning a $1 move causes a 2% jump on the one, a $1 move causes a 3% jump on the other, then a $15 move down hits our 30% stop on trade a $10 move down, $10 times 3%, it's our 30% stop on trade B. There we go. Does that make sense? Hopefully. If you need to go back and just rewatch the archive for this, you can revisit that math and get a little bit more acquainted with it. I've been dealing with it for a long time, so I'm in my comfort zone. For somebody who's brand new to this, it may not be comfortable yet at all. Bottom line, though, is just be aware that in the money options, less volatile, maybe we can use tighter stops. Out of the money options, more volatile, maybe the trader might want to use looser stops to allow for that volatility, not get stopped out accidentally somewhere along the way, even if our stock is generally behaving as we had hoped. So let's place our trade. I'm going to go to that. Let's do the in the money as our example today. I'm going to buy that 970. It's going to be about a $3,000 trade. I'm going to right click on this. I'm going to put in a custom buy order with an OCO bracket. So this is going to be an order to buy, let's just do one contract. buying one contract. I'm going to buy this. Let's see, what is there's a pretty good spread between the bid and the ask. Let's say we're willing to spend maybe, let's call it 29.10, sort of splitting the difference between the natural and the mid. Now, first, let's put in our target. Where did we decide we'd like to get out if we can get there? That would be if the stock made another rally like the last two, somewhat proportionate to the last two moves. We're looking to get out up here at 110. So going back to our trade tab, we're going to use our order condition screen to put in that requirement. We want to sell that one call at a future market value. We don't know when that market value might arrive. If it does, so we're going to make that good till canceled. If Costco, that market value, gets up to greater than or equal to $1,010. There we go. Let's save that order. Now, our other order is going to be our stop. With this, we're going to sell if we lose 30% of our value. So if we're buying in, let's get our calculator out here. Buying in at 29.10, let's multiply that by 0.7, and that tells us if we sell at 20.37. I say 20, yeah, 20.37. That's going to be our stop. If the value of our option ever falls down to or below 20.37, that will trigger a market order to get us out. And then we sell for whatever we can get at that point. This is not a guarantee that we'll sell at exactly 20.37. If the stock were to gap down, for example, we might sell at a substantially lower price. But at least we have drawn that line in the sand. All right. So that's it. Let's click confirm and send. And we're going to buy that one Costco 19th of September 970 call at $29.10. We're going to sell if we can get that Costco value up to 1,010, or we're going to sell if our investment drops down to 20.37, which is 30%, or in other words, $8.73 below what we paid for it. So again, if we're thinking about our delta, we could just mentally take that 873, pretty close. It's just an estimate, but that would be about a $15 drop in the stock price from our entry right now. All right, let's send this order off. Now, this one, there is a commission to be paid, so we need to be aware of that. That's to get into it. And when we close it out, there'd be a commission to exit. And as a reminder down here, due to potentially wide markets or liquidity risks at the time of activation, if we happen to move down to that stop, that's what it's referring to, that stop order may be manually substituted with a limit order upon activation and worked until filled. So let's send that order. And we bought it. They're in at 28.85. Okay, very good. Well, guys, we've actually accomplished what I set out to do today. I'm going to wrap this one a little bit early. I have another obligation I need to get to, but I wanted to talk through how a trader might decide when to use tighter stops versus looser stops when buying long options. Now, the same concept may actually be applied to long puts as well. Maybe we'll do that in a future webcast. But thanks for giving me your time today, guys. I really do appreciate it. We'll have another concept, deeper dive discussion in next Tuesday's webcast. This is what we do on Tuesdays. So if you enjoyed this discussion, I hope you'd put it in your calendar to join me each Tuesday. Now, obviously, I have other webcasts each day of the week on a range of other topics. So you're certainly invited to join me in those webcasts. I'd love to see you there. But as I let you go, just remember that you have additional resources outside of these live streams. Number one, if you haven't subscribed to our Trader Talks channel on YouTube yet, please do that. The full name of the channel is Trader Talks Schwab Coaching Webcast. You can subscribe by going down in the lower right-hand corner right now. Just click on that subscribe button. It only takes a second. It doesn't cost anything. But this is where we house our playlist of previous webcasts. So I could go to my playlist as an example. Just go to Trader Talk Schwab Coaching Webcasts on YouTube, go to playlists, And the playlist for this webcast series is actually right close to the bottom. Second line from the bottom. We have lots of different webcast series. But here's getting started with options. You can view the full playlist right there. And like you could revisit last week's discussion, which was managing credit spread exits using profit or loss percentages. So everybody, another suggestion I have for you is to follow us on X. Connie, thanks for helping out in the chat. And if you'd like to connect with us in between these live streams, best place to do that is on X. Actually, I have a poll going on X right now. You may want to check it out. But this is where I can post things that I see as timely. I don't have to wait until they turn the camera on so I can talk with you about it. I can post something, get your feedback, and if you reply to one of my posts, I try to reply right back to you. It's a daily habit of mine. Get on here, see who has replied to one of my posts, and just have a chat back with them. So you can find Connie on X at Connie Hill CS. You can find me on X at Cameron May CS. Everybody, thanks for giving me your time today. I'm going to let you go. Connie, thanks again for helping out in chat. Thanks to everyone who's already clicked a thumbs up. Out of 158 people watching live, I can see 58 of you have already clicked that thumbs up. That's always appreciated. It sounds like applause to your presenter. And it also gives us a boost in the YouTube algorithm, helps more people find our videos. So thank you for always doing that. But I will see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.